issue.
Thanks so much everybody for coming. I'm really excited because today we have a prominent guest here. So of course many of you know Meher, hopefully from Epicenter, which I'm sure all of you listen to every week. So he's always been amazing at researching things, and whether it's researching guests, but then he's researching his own thing, and he said 70 minutes the talk is going to be long, which will be the longest talk we've ever had. So I'm sure it's going to be excellent. Minutes. 70 minutes, yes. We will do a short break, probably. So yeah, I'm super excited about the talk. And well, before we get into that, so this wonderful space has adopted us recently. And so we'll give you a few minutes to Joachim, who can tell us a bit about Open Space.
Yeah. Warm welcome at Open Space. My name is Joachim. I'm responsible for this space and for Open Space. So this is once this was 7 times a year we met into these rooms, which was dark, it was awful to be honest, and this was a traditional bank. Now we are 100% daughter company of Commerce Bank, and this will be the place we start just in the moment we are into our beta, so we will start going live on 1st of Jan. And this will be the traditional platform, digitalization platform for the traditional German Mittelstand, so German corporates, where we want to speed their digitalization, we want to help them, what digitalization means, what skills do they need for the future, which kind of startups do they have to meet. We want to bring international startups into Berlin to help them to create their business in Europe and to find in that space their first customers from the German Mittelstand. So this is something Commerce Bank is building up, but it's on an open source architecture, so we don't have 2,000 people doing all this, what all our customers need every day. We are a team of 7 people, and there will be around 30 in the beginning. Later there will be more partners who help us to adopt and to speed up what digitalization is meaning about. So there will be programs, there will be a lot of meetup coming in the future. This is actually the 3rd meetup we are hosting in these rooms. We are very happy to have you here, and this should be a brief introduction to Commerce Bank. If you want to read anything more, it's www.openspace.digital. And give us just a short notice what we do, and enjoy the time here in our wonderful space. And let's go to Meher. Warm welcome again.
Thank you.
Also, just one more thing, if you're looking for the bathrooms, so when you came up on the stairs, you have to go left, and sort of in the corner there, the bathrooms are. There's also drinks out there, so please serve yourselves. As long as there are drinks, you can have them. And then one final thing before Mervyn gets started. So Sherman wanted to tell something about a contest.
Yep, just 1 minute. Hi, my name is Sherman. I run the Blockchain Hub here in Berlin. We also have a Blockchain Hub in Graz. They're actually conducting a blockchain startup contest. So you already sent the email last week, I think. So if anyone is interested in participating in that contest, or if you have some friends, deadline is the 31st of October. There is a prize of 15,000 euros. More information on blockchainhub.net, and there is a post, and you can go there directly. Thanks.
Oh, and I guess one final thing. So thanks so much for Ryan for once again live streaming this.
Hello everyone. As Brian said, I'm Meher, originally from India. I used to work in the vaccines industry, so I graduated out of university and I worked in the vaccines industry for 6 years. Discovered Bitcoin 3 or 4 years ago, slowly took over my life, and now this year onwards I'm like a full-time entrepreneur in this space. I do 3 things. Thing number 1 is Epicenter Bitcoin, or Epicenter as we call it. So many of you might have seen some of our shows, and I'm a show host there. Thing number 2 is this. this year I've been working on a white paper, and I finally came to the point where I thought I'm sort of ready to complete the white paper and release it to the world. But I thought before even releasing the white paper, I would get some reviewers for my work, and get some feedback from people outside and see what they feel about this work. And then I thought, what's the best place to get reviewers? And Berlin was what came to my mind. What better place to come to and present at? So this is the first time I'm ever presenting this topic. And it's totally original work. It's inspired by some work other people in the crypto space are doing, and I'll acknowledge them in the end. But what you're going to see is hopefully original work with completely original content. So if there's any errors, this is on me. Now, that's the second thing. The third thing I do is I'm a co-founder at this company called Validity Labs. And what we do is we build enterprise courses. So if you're an enterprise company and you want training in blockchain technology, some form, you can check out our courses. We have 2 major courses running now. One is Eris for Developers, which is a 2-day on-site workshop. In our workshops, we have our participants build things, not just have theory. So we build like mortgage-backed securities, where we show how traditional contracts and these smart contract programs can work together in order to do something like allow mortgage-backed securities, which is one of the bases of the real estate market in the United States. In the German market, you have something called the Pfandbriefe. This is the American equivalent of that Pfandbriefe. Then we have the second course, which is Decentralized Applications for Developers. It's a 3-day on-site workshop, and we get our participants to build something very special, and we actually get them to build parts of what I'm going to talk about today. So that's my thing. Now, before I start, I would like to have a survey of who exactly I'm talking to. So how many of you are programmers? By programmers, I mean you have done some form of smart contract or Bitcoin programming. You have written some script in Phobe, like the Bitcoin script, or on smart contracts. Okay, all right. How many of you would describe yourself as belonging to some form of like finance industry, like maybe financial services, banking, etc.? Okay. How many would be from law? How many of you would have a law background? Okay. And I'm sure like many hands didn't go up, so can you tell me can any of you tell me like what background are you from? Like, if you didn't raise your hand in any of these questions, can you just tell me what is your background? Design. Okay. Anyone else? Entrepreneur. Okay, so how many of you have startups? How many of you are entrepreneurs? Okay, fair enough. All right, so this talk, I'm going to try not to make this talk very technical, not make it very programmer specific, but anytime it goes too deep into one particular area you're uncomfortable with, just break and ask questions. So this particular work, it merges a lot of different fields together to build something, and perhaps you might need help with one of these things, so just ask your questions, right? Now, so the first section is going to introduce the problem. Yeah. Is this fine? If it's fine for Ryan, it's fine for me. I could maybe go even like this. Okay. So the first section of the talk is going to introduce the problem that I'm trying to attack, right? And it's quite an abstract problem. And the next sections will build on it, but let's just go to the first section in the beginning. So in this talk, we're going to talk about a particular invention. This invention was made in the late 1500s, and it ended up changing the next 2 centuries and transforming how history played out. Can any one of you guess which invention I am referring to? Sharmin?
The printing press?
the printing press. Any other guesses for what this invention might be? It was a massive invention. It still, effects are still felt today. The corporation. The joint stock corporation, that's exactly right. So we're going to talk about the joint stock company, right? Now, the joint stock company, if you think at the basic, at the core level, it's a very simple invention, right? You have investors or capital contributors, right, who have money lying around in some form. They pool their capital together, they create a pool, and they tokenize this pool. So this pool is represented as like what we would today call tokens, but back then we would call pool of stocks, right? They would call it stocks in England. And then comes the symmetry in this setup, which is when you build a joint stock company, if you invested capital in the beginning, then you automatically become like a stockholder. You get one of these pieces of paper that makes you a stockholder, and you can sell one of these pieces of paper to anyone else who might desire to be one, right? It's a simple invention. So simple we never think about it. But the beauty of this invention is, according to me, this, that you have in the beginning like a pool of capital that is accumulated. You have represented that pool as like stocks, and then you can have something which is called incorporation, which is like a legal term that gives some form of legal agency to this pool of capital and stocks, makes it an independent entity. And this independent entity, the most common use for which it was deployed when it was invented was for the purposes of trading with Asia, right? So mostly these joint stock companies, they ended up buying ships, they ended up buying weapons in order to fight with the natives in Asia, and then they also ended up buying land and buildings and offices, etc. They ended up building their own cities. If you would go to the history of Indonesia, there's a city called Batavia that was built by one of these corporations. It's a very simple design, but the beauty of this design is that it gives a direct financial incentive to all of these shareholders or stockholders, right? All of these stockholders are in their heads thinking, I need to grow this pool of capital. I need to grow this pool of capital. That's what I need to do, because if I grow this pool of capital, the token that I have or the stock that I have will grow up in value. And it distributes this kind of incentive among a lot of people. This was the unique thing about this thing, right? This invention was super successful. So before we go to the success, these stockholders might end up employing a management to take care of these assets, right? But it's just one mechanism by which they can grow this pool. The fundamental construct is the stockholder or shareholder, not the management. The management is a tool the stockholder uses in order to grow the pool. This was a massive invention, right? Today we might think, yeah, it's a big invention, right? Like Google is massive, Facebook is massive. We see the control these entities exert over us, but this is nothing compared to their heyday. In their heyday, you had the Dutch East India Company, which ended up ruling over a vast piece of land of what is now today Indonesia, right? That's the Dutch East India Company. And they had a very strong navy. The company had a whole navy at its own command. And then you had the English East India Company. So the English East India Company ruled India for 150 years until 1857. So imagine that. We had times when like 1/5 of humanity was actually ruled by a joint stock company. That was the height of this invention. That was the success point of the invention itself. These are the headquarters of the joint stock of the English East India Company in London, sketched by an artist. So with that sort of background of the joint stock company, I want to introduce the next idea. The next idea is a bit radical. And this idea was created by a journalist, an American journalist called Michael H. Goldhaber. And Goldhaber had a very radical idea. Let's walk through what it was. He said, like human civilization, it goes through jumps. like some set of inventions happen and the way society is structured ends up changing completely. He said the perfect example of such a jump is the jump from the feudal economy to the industrial economy. And he randomly times it between like 1500s and 1600, like somewhere between that we transition from a feudal economy to an industrial economy. And now the natural question is, if there are transitions, what marks these transitions? And like Goldhaber has his unique answer. His answer is the transition between the feudal economy and the industrial economy is in what society values as its fundamental scarcity. So in the feudal economy, right, when you go to a museum, you realize that the fundamental scarcity in society are relationships. The serf has a relationship to his master, who might be a knight. That master has a relationship to a noble, right? And that noble has a relationship to a king. And most of the activities that people used to do was in order to secure better relationships. You want a better relationship. If you're related to the knight, you want to be related to the noble, etc., right? And courts were one institution that allowed people to make these relationships. And then once the fundamental scarcity is a relationship, then you have technology to preserve these relationships. So a castle, it's a technology a king uses to preserve his relationship with the lords, right? I have the biggest castle, you have to keep this relationship to me because I own this castle. So all of these technologies are there in order to preserve this scarcity. But he said, like in the industrial economy, the scarcity is different. Like the radical shift was, instead of relationships being valuable, now we started to value something which is abstract, something which is money. It's the most abstract thing you could imagine. But that is the essential scarcity of the industrial economy. Everybody is doing something in order to make money. Once you have money, relationships will follow. Once you have money, you can buy a title. Once you have money, you can become a lord. Once you have money, you can buy land. That's the fundamental shift. And this shift explains something. Why did such a simple invention, such as a joint stock company, not happen before? Because capital wasn't the essential scarcity then. But his radical jump was this. He said the industrial economy is past its prime. The industrial economy seems very strong to us. Capital seems very strong to us today. Money seems very strong, but it's past its prime. And the next quantum jump in human economy is from the industrial economy to the attention economy. And what marks this shift? What marks this shift is the nature of the scarcity shall again change. So the nature of scarcity goes from capital to attention, what we today interpret as likes, upvotes, and favorites tag, etc. He was a visionary because he came out with this theory in 1996 at the beginning of the internet. And that time there wasn't any Facebook, Reddit, or Twitter. We can feel the scarcity right now, right? Like everybody you see is on Twitter trying to earn these things, right? Like this is a measure of scarcity in some form or the other on the internet. So that's Goldhaber's radical idea. And what I'm going to talk about today is this question mark. So every economy has its own technology, and the attention economy's fundamental technology is the internet, right? We pay attention to each other over the internet. But is there a joint stock company equivalent of the attention economy? That's my question. That's what I'm trying to solve. That's what my white paper is about. Is there something in addition there that is equivalent to the joint stock company here? So this is where we are going to. Can something like this exist? That you have content consumers or people who have spare attention, that they pool their future attention streams, that they agree that they are going to visit some digital place together every day, right? Can they pool their attention, not capital, but can they pool their attention itself, and then tokenize it the same way you tokenize capital in order to make shares, and you represent it through crypto tokens, and then you distribute these crypto tokens to the token holders that are pooling their attention. Is there a simple joint stock equivalent for the attention economy? Right? Now, I'm going to call many times during the talk the joint attention network as Jane. Joint attention network, Jane. So if I use that sometime, you remember what I'm talking about. So in this talk, we are going to walk through one possible design and implementation of a joint attention network. Takeaways from this talk. The first section, we are going to reinforce the value of attention streams, and there's a particular way I want you to look at attention on the internet. Then I'm going to introduce like one simple joint attention network that has a crypto token. This crypto token is called an attention-backed asset. Right? And then, provided this design is correct, what does it mean for the broader web? That's the third phase. Right? So this, as you can see, is going to be a big talk. It's going to be a long talk, and we are going to have a break in the middle. So I'll time the break maybe after the second section or the third section. Let's see. So any questions? Okay, not now. So in the first section, we're going to develop like some intuition for how money is made on the internet, right? What attention is and why is it valuable. So first, we're going to forget about the internet and let's think about a periodic gathering, right? This is a periodic gathering. You meet once every month. But you might imagine traditionally a church group or a big music group that meets every fortnight or every week. Imagine that kind of group, right? That's a periodically meeting group. And I'm the organizer of this group. So, I'm the leader. I'm the organizer. They all come to listen to me. Let's assume that for the beginning. Now, I come to each of you and I offer you this, that I'm going to install like 2 screens when my community meets every week. And then I want to sell you the rights to these screens. If you buy these rights, whenever our group meets, you can have 5 advertisements, 10-minute slots, be displayed during the evening, right? So if we meet on a Friday evening for like, say 5 hours, each hour you get a 10-minute slot and you can show it to all of the people that are meeting, right? They don't need to see it, but it's their choice whether they want to see it or not, but like you can display your ad here. And I come to you and say, I'm selling you the rights to this, right? You can now display your ads if you buy this from me. Do you think what I'm selling to you is a valuable commodity? Would you pay money for it?
Yes.
Right? We don't have any problem appreciating this, right? So I want you to think a bit deeper though, like how do you put a mathematical number to this right? So the way we might think of it is, hey, if one of you buys this thing, you can essentially sell these 10-minute slots to advertisers, so you can make revenue out of it, right? So you can make revenue, but then you might also have some costs. The cost might be you got to keep that screen running, right? So you have revenues and you have costs. So if you subtract costs from revenue, you get some measure of profit. And you should be willing to pay as much profit you're going to make to buy these rights from me, right? That's like traditional financial valuation. So we might have some very simple calculations like revenue. What is the revenue from a screen like that? Number of reachable impressions per week. How many people can see this thing? Market value of impression and factor for number of weeks. So if 5,000 people meet every week, then 5 slots, 25,000, let's say only 80% of them end up seeing this thing. So 20,000 impressions, 25 cents per impression, and 50 weeks, $250K. On the cost side, maybe you need to install some hardware, $10,000, and then maybe you need to spend $200 every week for it. That's 20K. And now every week you make some revenue and you have some costs, but if every week you have some cash flow, but if you add all of these cash flows, then what you should get is the intrinsic value of the screen rights, right? So every week, if I have like 20,000 impressions and that's market value is 5,000, and I cost $200 to maintain the screen, that's $4,800. I can do that for 1 year. So if I add all of these $4,800 across the year, that is the value of this right? The right to display something on the screen. So I present it like this, right? Net present dollar value of monetizable attention stream minus cost to maintain and grow attention stream. This is what is the value of the screen, intrinsic value of screen rights. And for, okay, that's not good. Can I change to my laptop?
Yeah.
Okay. So what you have is something simple, right? There's some form of resource which is money you can make using this screen, and it occurs regularly every week. And the financiers, they have a way of making these calculations. They have formulae like this, which can take these variables as input and give you a final value of the rights, right? So these are like financial valuation models. I'm not going to go into the mathematics, but once you start to think in terms of revenue and cost, you can write a financial equation like that. So as an example, 20,000 impressions per week, 20 cents, 25 cents per impression, 3% annual interest rate, the whole rights would be like $8.62 million if you buy the rights from now until infinity. So you can have models like this, but the core notion is simple. We can place a value to attention. Now this is actually also valid for digital attention streams. So what's a digital attention stream? Let's take an example. Each second, thousands of people are searching on Google for, let's say, a word like basketball shoes, right? They want to buy basketball shoes. Every 1,000, you can imagine this like as a stream of bullets, like people are searching. What Google does is it places ads when people search basketball shoes, right? Now, so if you could imagine that to Google, they want to make a lot of money from this word basketball shoes. So they want more people to search this, and they want a lot of people to click on these ads, because every time you click on an ad, Google makes money. So imagine you are Larry Page, right? Now if you are Larry Page and you own Google completely, this word basketball shoes is valuable to you because people are going to search it in the future. You're going to make some revenue from it. You're going to have some costs to maintain these servers, but revenue minus cost gives you money. And this money keeps on coming every second from now until infinity. So that's value, right? This word basketball shoes has value to you. And surprisingly, you could write a very simple equation to value this, right? You could say searches per second multiplied by fraction of searchers clicking on ads. This is around 2 to 3% for a word like basketball shoes into revenue per click. So advertisers pay different amounts for each word like that. So basketball shoes, the average is around $1.2 per click. That's what advertisers pay Google in order to have these ads clicked by the consumers. So you can say, like, from Google, every second, because people are searching, they're making money, and you could do that same kind of calculation for Google. So if I have done the calculation for you, from now until infinity, 1% clicking on ads, $1 per click, and million searches per week, that would be $172.4 million. That's what they value this keyword at. And now, if you think of it on a higher level, then what is Google in the end? What is Google search in the end? Google is just a machine that makes money out of these keywords, and it has thousands of them. Each word in the English language is a money-making machine for them, right? So just as the way I could value basketball shoes at 172 million, I can put a financial value to each word in the English language, in the German language, And if I were Larry Page, and if I added all of these values, then I would get the total value of Google search as a business, right? Because that's the money we are going to make in the future. This is actually pretty familiar to media people, because like Reddit would also work like this. Every time, like, are you all aware of Reddit, right? So every time, so Reddit has lots of subreddits, right? Reddit.com/r/Bitcoin. So every second, hundreds of people are visiting this page. There's like ads on side of the page. People click this ad. For every ad they click, Reddit gets some money. So every subreddit is valuable to Reddit, the thing. And if you add all of these subreddits, then you get the total value of Reddit. So what I'd like to say is, just the same way we could value like a group meeting regularly, we can value Google search in terms of how much attention it's going to get in the future, right? So you could have a formula like this, like current owner's equity, which is how much money do the owners of Google have in the business currently, in like physical assets, assets in the form of money, plus how much they're going to make money from the future attention that they're going to get on this site, minus how much it's going to cost to them to keep this machine running, right? To keep Google search running and grow this attention stream. So you could value something like Google in this abstract form. Now, if you might have ever studied Warren Buffett, Warren Buffett has this famous saying that the value of a company, the intrinsic value of a company, is the net present value of its future cash flows. So if you have any company, then it's going to generate cash flows in the future. This year is going to make some profit, next year as well, etc., on to infinity. If you take all of these cash flows and you sum all of them, then that's the value of a company. This is similar, right? Except I have stated this in the form of attention. So I can value Google in terms of how much attention it's going to get on its site. And I can write a formula for it. I won't get into it, but I can. Assume that for a moment. So now I'm going to go through this section, leave you with a question, and then we'll break for 5 minutes or 10 minutes, right? So I'm going to tell you a simple attention-backed asset, right? Like I'm going to explain what this to you through an example, what this is to you through an example. So let's go back to that previous example, right? People are meeting regularly, and there are these screens, and there are some numbers like how many people, etc. But we're going to tokenize access to these screens. We are going to involve crypto tokens in our thought experiment now. So let's say there are some organizers. Brian is an organizer, right? For some other meetup, somebody else is. And they do something unique, something very simple now. They go to Ethereum and they create 1 million tokens. They create this smart contract. That smart contract has 1 million tokens. On a particular meetup, when people come, let's say the 5,000 people come on this day, and there's 1 million tokens. They give 200 tokens to each person that comes. They distribute all the 1 million to these 5,000 people. Simple. And then this is the next leap that they make. They say, let's create a social convention. What's that social convention? The social convention is this. If one of you who owns the tokens is an advertiser, and these tokens are traded on exchanges like Poloniex or whatever, right? Whatever is the best today. I have no idea. But these tokens are traded on exchanges. And we say as a community that if you're an advertiser, if you buy this token on an exchange, and let's say you want an ad displayed, so put that ad on a file system like IPFS. How many of you know IPFS? Okay. So for those of you who don't, this is very simple. IPFS is truly simple. You can imagine it as a Dropbox in the air, right? Like you can put a file there, you can take it back. There's some more characteristics to it, but that's about it, right? So in the social convention, we say people, advertisers can like put their content, their ad or whatever message they want displayed on this file system, IPFS. And then they have to burn some tokens. So they have to take some of the tokens that we have created, which are called let's say meet points, and they have to destroy these meet points, like send them to an address from which they can never be recovered, right? How many of you are familiar with the notion of burning? Burning. Okay. So just like if I have dollar bills in my hand, I can put them on a piece of fire, and then I can't spend them anymore. I can do that with crypto money. If I have my address, Bitcoin address, I can send this crypto money to another address, and that address, let's say it doesn't have a password, and it cannot have a password, then nobody can spend those coins, that money. That's called burning, right? You're destroying this money. So they create this convention. Advertisers can buy the token, and they can put their content on IPFS, and then they can burn some of these tokens. And then you do another thing. Like when you burn these tokens, you have to link that transaction to your ad or message, right? So when you're burning, you can put some extra data with it, and that data contains the link to the content you have put in IPFS, in this file system. And then we create a simple social convention. We say, whoever burns the top 5 people who have burned the most amount of money the past week, let's say we're meeting on a Friday. So the past week, we're just going to figure out who burnt money, right? And we're going to select the top 5 people who have burnt this money. And we're going to see what messages they want displayed. And those are the messages that are going to come on the screen, right? It's completely decentralized. Like there are these advertisers, they are putting the message, they are burning these tokens. And then whoever is the top 5, their messages are going to come on the screen every time we meet. Like every week we meet, every week this will repeat. So for the programmers in the audience, and if you're not, there's no problem. It's a small slide, just one. For the programmers in the audience, they would realize that this is very simple to build, because all it needs is a file system like IPFS to put the content. Then it needs a blockchain like Ethereum, where people can burn these tokens, create these tokens and burn them, and tag the content here with these transactions. Then you need a server that's going to go to these IPFS and Ethereum systems, scrape all the data, figure out the top 5 burn transactions, and then it's going to display, the server is going to display on these 2 screens those messages, right? It's a very simple thing to build actually. And maybe we could also make it more complex, like once you start to think smart contracts, you could say that these advertisers, instead of directly burning, they could send the money to a smart contract. And the smart contract sends all of the top 5 amounts, it calculates all the top 5 amounts, and it burns those amounts. But if you are not in the top 5, you're 6th or 7th, then you get your money back from the smart contract, right? So only the top 5 advertisers have their tokens burnt, and nobody else suffers if they put in too little money, right? Very simple setup, right? Do all of you get it, or there's some confusion on this?
Is it like eBay that bid on products, the highest that goes through?
Yes, you're bidding on attention. This is a very good analogy for it, right? There's these screens that allow you to access the attention of everybody that's there, and you are essentially auctioning. This is an auction mechanism for accessing that attention, but it's a decentralized auction. There's no central party to this auction.
So how can I know as an advertiser that somebody else is like putting more tokens, right? And the odds that I'm becoming the number 6 or 7 would get higher.
So there could be many ways, but right now I want you to think very simple. And in this very simple thing, I'll say that the advertisers don't know. They put their money in, and they know that if it's in the top 5, it will get burnt, and their message will come on the screen. If it's not on the top 5, then they will get the money back, and they have no control over it.
So I get the proof of burn to get the attention part, but what's the proof of attention? How do you prove that you're paying attention? And not like in the early 2000s, there were websites that were showing advertisements and giving you money back, and you were not paying attention. So
Yes. So for the advertiser, once you are an advertiser, you burn some money. Let's say it's 1 week, like week number, let's say this is week number 30. Before week number 30, you burned some money. And then you have some way of verifying that people actually came, 5,000 people or whatever came to this event, right? Like maybe you send a person there, you verify somehow. And there's two cases. Case number one is 5,000 people actually did come and your message was actually displayed, and then you're fine. Case number two is either the people didn't come or your message wasn't displayed, and then basically you don't get your money back, but that's just 1 week. You can agitate on the internet, and once a lot of advertisers realize that people are not actually coming, they will just stop burning their money. So in this scenario, some advertisers might be cheated, but we want to keep the thought experiment simple. So I will say the advertisers verify in some way physically, and the advertisers could be cheated for a week or two, but then they will catch on and they'll realize that this is happening and not burn anymore. Simple construct, right? This is like a thought experiment. I want you to think simple, right? Let's keep it very simple. Any other questions? Okay. Now, do you think, now my question to you, do you think if this system works, right, if these people are actually coming regularly, do you think these tokens have value? Would you give money in order to buy these tokens if you were an advertiser? Sure, right? No doubt, right? If the attention has value and these tokens, if by burning them you can get that attention, then that attention is a commodity. You can burn something, get a commodity, then that thing that you burn has value, right? So now comes the financier's question. How much value does it have? How much will you spend in order to buy one of these tokens, right? That's the financier's question always. And in order to answer this question, like how much will you pay to buy one of these tokens, you can think of a very simple experiment, another simple experiment. You can think that let's say there's a magical treasure chest, right? Sindbad the sailor's magical treasure chest. And this treasure chest has a very magical property. It's locked, there's no key to it, there's no way to open it. But then there's this piece of chocolate, right? And this treasure chest is such that if you break off a piece of the chocolate and you burn it, then a bit of the treasure will appear magically in front of you. So if there's like 100 slabs to this piece of chocolate, you break off one slab and you burn it, then 1% of the treasure will appear magically in front of you. Right? You can think of that experiment. Now my question would be, how much will you pay for this chocolate? Let's say it's very poor quality chocolate, like the chocolate itself isn't worth eating, but when you burn it, you get the treasure. How much would you pay for that chocolate? What the treasure is worth, right? So this chocolate is like a treasure-backed asset. Right? You can think of it, right? Because this chocolate allows you to access the treasure. The treasure is worth something, so it's a treasure-backed asset. What we have gone through is an attention-backed asset. I burn these tokens, and attention appears, right? I can get access to some attention. That's an attention-backed asset. This is a treasure-backed asset. So for a treasure-backed asset, you said, okay, the value of the treasure should be the value of this total chocolate bar, right? I could sell this chocolate bar to somebody and get exactly the value of the treasure out of it. Like if this is right, and this is something this is a formula I'm writing myself, right? I can't look this up in a textbook, but I think exactly the same thing holds true here, right? So I can say this attention-backed asset that also has an intrinsic value, just like a share has an intrinsic value. And that exactly looks like the same thing we encountered in the earlier, right, for Google and for the other example. That's monetizable attention stream. How much is this attention worth? And how much does it cost to maintain and grow this attention stream? Yeah.
I'm sorry. I think the value depends on the objective of the advertiser. I may want conversion. I may want to just raise brand awareness.
Let's say it's brand awareness. You're just doing it for the impressions.
Because you can use just simple model because it depends on what I'm selling.
Yes.
So the conversion is different.
So the conversion is different. Out here we are just selling impressions, right? Like how many people are going to see your message when it's displayed. We're not talking about clicks or conversions, we're talking about impressions. We're talking like the old TV model, right? Like when you know if I broadcast a TV with the Bundesliga, I think these many people are going to see my ad, but it's not necessarily they're going to buy it. We're talking that model, right? So I want to think of this thing as a treasure and this thing as a chocolate, right? The token is the chocolate, the attention stream, the monetary value of the attention stream is the treasure, and these have to be equivalent or proportional in some way. So provided this kind of thought process is right, if you have one of these tokens that represents attention of 20,000 people, 20,000 impressions per week, like 5,000 people meeting and like 5 ads, and 80% of the people only seeing these ads, the rest 20% not seeing these ads, 25 cents per impression, from now until infinity, financier's model will give something like $8.62 million. That should be the market cap of this token. Now I want you to go back to this slide where he said the beauty of the joint stock company was that all of these people want the value of the token they hold to go up. And the way they can have this value of token go up is to maximize the pool of capital and physical assets represented by this capital in the corporate body, right? It's a distributed incentive structure. So I want you to think, and I want you to answer. Let's think if you were one of these token holders. You come to this place every week and you own some of these tokens. And these tokens are attention-backed assets. What is your incentive? You want the value of this to go up.
To make my crowd bigger.
To make the crowd bigger.
Or more attentive.
Or more attended, right? And?
Or burn more tokens.
Burn more tokens. Get other people to burn more tokens.
I want to address the right target group.
Right target group, okay. Right? So you have it. You have it. What is the incentive of this token holder? The incentive of the token holder is to bring more attention. The group becomes bigger, from 5,000 goes to 10,000. Now it represents not 20,000 impressions per week, but 40,000 impressions per week. So the value of the asset increases, the more the number. The other thing is, one of you said, get content promoters to burn tokens. Let's say all of us are holding this token, right? Now you intrinsically know that Satoshi Nakamoto owns 1 million bitcoins, right? Now, suppose it turns out that Satoshi Nakamoto has truly burned the private keys to his 1 million bitcoins, right? What do you think would happen to the value of your Bitcoin? Go up? Go up, right? Somebody else burnt 1 million bitcoins, so your value of a Bitcoin goes up. Right? So when an advertiser is burning some tokens, your tokens are becoming more valuable because the tokens are essentially limited. They're like Bitcoin, they're scarce. And these represent some attention. So your incentive is to get more people to burn these tokens. So remember these two legs, right? You want to bring more people and you want more people to burn tokens, right? This is what you want. That's your game. So now many people say like, this is all fine and dandy, but like I hate the idea of burning tokens because you are burning money, you are wasting money, man. Why do you want to waste money doing this experiment, crazy thought experiment? And like, so here's my answer like to that. It's like, generally in a crypto system, you have anonymous token holders. We all may not know each other. And when someone burns in a system like that, Bitcoin or Ether, what that person is effectively doing is they are paying everyone else, right? When Satoshi burns 1 million Bitcoin, he's paying the rest of the Bitcoin holders like us something without even knowing who we are, right? So it's a mechanism by which when I burn something, I pay everyone else who's holding it without knowing who they are. That's why I'm using this burn mechanism.
So it's not like sending money where?
No, it's not like sending money. It's like, so it's like assume there's a smart contract, right? So the way I like people to imagine a smart contract is like a robot. So assume like this robot. This robot has the capability to accept money. Like people can send it money and it can accept money. But the programmer didn't give it a capability to dispense money.
Like a black hole.
It's like a black hole, right? This thing can accept money, but it can't dispense money. So whatever you send to it and its code can't be changed, right? You can do that thing. So it can accept money, its code can't be changed, but it has no mechanism to give money. So nobody can use that thing. Nobody can use that token anymore. That is what I call burn, right? Like eatable gold. That's another analogy for it, right?
And this robot is,
But eatable but not shittable.
and this robot is,
Okay.
and this robot is what is this robot?
This robot is a piece of program that runs on the Ethereum network. So
That runs the network. Right? The whole network runs based on that.
yes, the whole network runs this program. There's no way to change this program, right? Once set, it's there. And it's like once you made a program like that, somebody sends money to it, that money is gone. Those tokens are gone forever. Like they're deleted from the world. Okay, so that's why burn, right? It's a way of deleting this money, but it's like you pay all of these other people when you burn these tokens. I'm going to skip this slide because it's already a lot. Sorry. So we said this in the past, right? We said this, that you can have like chocolate and treasure and you can have an equality between these two and you can write an equation like that. And then I can scare you with writing something like that, which I won't get into right now, but I can write it down mathematically, right? I can tell you like how much the price of this token should be given what you think, how many people are going to come in the future and how much will advertisers value this thing at. So I can write an equation like that. But we don't care about the maths right now.
But like how? When we're talking about value, a very important input is trust. And
Yes.
how do you value that trust?
So the trust that you will actually get this attention, maybe you can't estimate it perfectly, but you can always add a factor to it.
Yeah, but
There's 50% chance I will get this, let's say. Let's keep it simple. Let's say you can add a thing like that, yeah.
And that system, how would new tokens be created? Is it when the audience grows? Or?
No, new tokens will never be created. So the organizers, these two nerds, they created 1 million tokens. They distributed 200 to each of these attendees. And when they created these tokens, they also had a rule that you can't create any more tokens. That's it. It will be 1 million. That's it. And people can only burn these things. You can only destroy them. You can't create them. And these things are buildable using Ethereum quite easily. Right? So,
And the promoters buy these tokens of people, right?
hmm?
And promoters kind of buy these tokens.
Buy these tokens.
So promoters can benefit the network by either buying these tokens from people and Bear.
Yes.
Got it.
So assume all of us get some tokens, right? None of us is an advertiser, but these tokens are now listed on Poloniex. So on Poloniex, some advertiser can buy it from one of you, because that person buys, the value of your token could rise, because like there's demand to buy these tokens. This advertiser can buy the token, they can only burn it. You can't get more tokens. Somebody here had a question.
Yeah, does we fall into a price owner's dilemma in the situation? Like if we're a member of the community, we have an incentive to make others sell it and keeping it for us.
Yes.
So
So think of it like this. Now, we said about the joint stock company, right? Now imagine you owned the share of a really nice company like Facebook. I'll reverse the question to you. If you are a Facebook shareholder, don't you have incentive to hoard Facebook shares or not sell it to anybody, keep it to yourself?
Yeah, depending on what we expect that will come.
Exactly, right? So out here it's similar, right? You have these tokens, they will rise in value if the number of people attending your meetup increases. But if you start but if you need money immediately, then you might want to sell the token, right? You need money for something else. There's a better investment, you need the cash to pay your rent or whatever. But if you don't need money and you actually believe in your community that it's going to grow bigger in size, then you will hold this token, you will never sell it. You won't want to sell it, right? Because it can grow up in value. But it's the same thing that any share does to your mind, right? You want to hold a share because you think it might grow up in value later.
They get only work for physical gatherings, or do you also see it on online?
Yeah. Now that is the perfect question. That is the perfect question. And that is the question I will leave you with before we break. I will really leave you with this strange truth, the strangest truth of them all. Our attention-backed asset, this thought experiment we did, was tied to a physical location. People meeting together physically every week, every quarter, whatever. Cryptocurrency related attention, strangely enough, is tied to a digital location. That digital location for Bitcoin is reddit.com/r/Bitcoin. Every moment, Bitcoin holders, some of them, are going to reddit.com/r/Bitcoin. And this is an attention stream that is continuous. Like every moment, there are some people there, right? So I created an attention-backed asset when the attention was tied to a physical location. All of us met here. What I want you to think about is, during the break, that cryptocurrencies, in their strange way, they change us. Like when you own a cryptocurrency, you are anxious about it. You want its value to grow up. You want to follow news about your cryptocurrency. You want to tell your friends how cool a currency this is. And this behavior, what it translates into, is a lot of people visiting reddit.com/r/Bitcoin every moment. So that is also an attention stream. It's just a digital attention stream, not a physical attention stream. So if I could create an attention-backed asset here, can I create one here? We will break on that thought. Okay, let's start. So we left with this question, right? Like, and somehow you know, because I'm presenting, this should be possible, right? There should be some form of attention monetization linked to cryptocurrencies. So the next 2-3 slides are what if slides. And I'm now going to describe you like sort of a vision rather. So what if the future of the crypto space was a new kind of social media? And what's the difference between this new kind of social media and the old kind of social media? So in the old kind of social media, there's always a choice that a platform provider has in what to display on top and what goes on in bottom. Anywhere you see, YouTube, Twitter, Reddit, Facebook, Instagram, what goes on top what goes at the bottom? Who decides? Platform provider decides. The platform provider takes two things into account. It takes into account recency. People want to see fresh stuff. So your post on Facebook will show up on your friend's feed for the next day maybe, and if it doesn't get many likes, it's going to disappear. Recency matters, right? What I posted right now shows up higher. Upvotes and likes. I posted something, a lot of you liked it. If a lot of you like it, it can fight, like as time passes, it becomes less recent, but because lots of you liked it, it still shows up in my friend's feed. And it can continue to stay up if a lot of people continue to like it. But these are the two dimensions. They combine these two things to determine what goes up and what goes down. Every social media platform does it. These social media platforms are closed data. All of the data you put lies on the server of Facebook or Twitter, and that's it. Only they have the global God's eye view of what everybody is doing on Facebook. We don't. There's a single UX. Facebook gives you a single UX. That's it. Take it or leave it. You have a mobile app, you have a web app, maybe you have a desktop app. Facebook is also monetizing attention. So have any of you ever had a corporate account on Facebook? Corporate account, corporate account, corporate account. Few of you. Go to Facebook today, build a corporate account. Once you do that, every day Facebook will send you messages. The last post, the last post you did, it got 150 impressions. Give us $10 and we'll have it get 1,000 impressions. Go to a corporate account. It's the normal thing, right? You can trade attention for money or money for attention on Facebook. Once you have attention, once you have money and you have a post, if you pay Facebook money, it will appear higher, right? But it's generally these two things, like the natural dynamics of the system are just these two things, right? Now what if we could build this decentralized? So we could have open data. All of the things people are posting go into IPFS, open data. So for those of you who don't know IPFS, it's like once you put something in IPFS, it's not linked to a particular company. Anyone else can download it, provided somebody is hosting it. So like once you ship something to Facebook, Facebook is not a good example here. Once you ship something to Twitter, once you ship something to Reddit, it's hosted on Reddit server, right? There's a wall around it. But on IPFS, once you put something on IPFS, it's not hosted by one company in particular. It can be hosted by anybody. You can yourself host it. Like the past Twitter feeds, like if you have an IPFS Twitter, what will happen is you can host all of the messages that you have put on Twitter yourself on your own computer, and anybody can look at it. You don't need a company to host IPFS, your messages on IPFS Twitter. That's the specialty. But you sort of, what you do is, in these IPFS Twitter or IPFS Reddit or these new digital forums or this new social media, it takes into account these three things. So recency, okay, people want fresh content, upvotes and likes. So let's say all of us own one coin. Let's say all of us are interested in football, right? And there are a million of us, and all of us are some of these people. We all own football coins. So we have this digital forum where all the football related news comes, right? So the question is, what comes on top, what comes on bottom? So what if we build a new social media that it counted recency, new football stories come on top, upvotes and likes. If all of us own tokens and using that same address, we upvote certain things, then these digital forums count all of the upvotes, and the more upvotes it has, the more the messages go on top. But the third thing they count is token burn. So let's imagine that there's some, for this football coin, there's some company that sells football related equipment. It sells training equipment. So you might imagine for this training and equipment manufacturer, it wants its message to appear on top of our common digital forum, right? So what this person can do is they can buy football coins, they can put their message, they can burn these tokens, and their message appears higher than it normally would, right? So you take into account these three things in determining the order of messages. Now we saw previously that once you have this notion of token burn, that gives the coin some value, right? So once you have a system like this, the hint I want you to absorb is, okay, these football coins might also have some value, but we'll get to this later. This is what I call, okay.
One question, let's assume I'm part of the football community. When I join the community, when the tokens are distributed among us, do I have to pay for the token in the first place, or do I just get it?
Okay, so I'm going to give a smaller answer right now and then we'll expand it later. And this question actually goes into the work of, not my work, but there's another guy called Simon de la Rouvière, pretty famous guy in the field. He's working more on this problem, so it goes into his thing. But the simplest thing you might imagine is, it's not an ICO. The simplest thing might be, you somehow figure out who are the football enthusiasts in the world, you create this coin, you distribute it to all of them. You don't raise any money. Let's not think of an ICO, right? I as an enthusiast, I create this coin, I figure out a lot of enthusiasts from maybe some list and distribute it to all of them. These guys get the token and then they can choose to hold it or to sell it. So that might be the simplest thing at the beginning. Then we'll go into these kinds of problems. Can there be an ICO model to this? So this kind of thing I want to think of as an abstract idea, a joint attention network, right? This is a joint attention network. So all of us are owning this token, and just as we were meeting at one physical place, we kind of, because we are interested in football, we go to this digital location every day, right? In the morning we want to see the news, we go to this digital location, right? I own the coin and I go to this digital location because I am also interested in the news or the stream or the feed that's coming, right? And so this digital forum, this coin and the holders, without any ICO, is what I call a joint attention network. So I called it Jane. I call these things Janes, right? And these Janes need not be like Ether and Bitcoin or things trying to be money. These Janes, in my opinion, can be linked to all sorts of interests that humans have. Here I've taken some examples. Cricket. I'm from the erstwhile English Empire, and I gotta love cricket, you know. So cricket coin for all of those like me. Soccer coin, football coin. A lot of young European men, women, they would want to have a coin like that. Communist coin, political affiliation coin, communist coin. A digital forum where the communists discuss things. Imagine that. Libertarian coin. Not Bitcoin coin, libertarian coin. Place where all the libertarians meet and discuss. And that coin has value because you can burn it and you can get the attention of libertarians around the world. Fashion coin. All the men and women interested in fashion of all sorts. And makeup companies burning these tokens in order that their messages appear higher. LGBT coin, right? LGBT community. Profession coins, cardiologist coin. Go and distribute your coin initially to like 100,000 cardiologists around the world. Focus all their attention in one digital location. Real estate brokers coin. Religion coins. Judaism coin, Hinduism coin, Christianity coin, Catholic coin, all of it, right? So if this design is right, then I think this is the space that exists. And you can imagine like the thing I hate about the crypto space is that, let's not say hate, but the observation I have about the crypto space is everybody's trying to build something that exists in the current financial system, and I'm just going to build it crypto style, right? I'm going to build asset trading crypto style. I'm going to build this bank process crypto style. I say, why not build something that is completely new, that doesn't exist? Which is why I'm like trying to work on this, because I think what's missing in the world are these are ways to monetize your interest, right? Like, so today, if you want to make money, you have to work for a company. But there's no way really to monetize your interest. Like some of us are really interested in Minecraft. Minecraft is really what we do. That's what we like. That's our interest. What if there was a Minecraft coin, and that Minecraft coin had some value, and if you could grow that Minecraft community, you could benefit from it, right? What if you built something which was radically different? Yeah.
My incentive, if I join a community like Minecraft or whatever, that there are good people there, that I have good conversations, and of the coins, like if there's another forum with like less people that only want to make money with the coins, then I want to go there because I don't want to make money. I want to have like good conversations and good relations. What's the improvement than just selling ads if I'm for like a hoster as normal ads with money?
So what you are saying is, I'm going to answer your question, but we need to wait a few slides for it. There are two kinds of people, roughly. In a Minecraft coin, there are some people who are interested in this and want to make money of it. There are other people who don't want to make money on it, but they just want to follow news related to Minecraft. Your question is, how do you balance these two opposing things, right? In a certain way, your question is something like that, and we'll get into this. We'll get into this problem. Now, let's also think of like kind of UX, right? So we said all of the data goes on IPFS, which means it's not held with one company. It's held like distributed. And all of the burn transactions and coins go on Ethereum, which means it's decentralized, not owned by a company again. What that means is, if there's a Minecraft coin, anybody can build a UX for Minecraft coin, right? Anybody can build a forum that just displays all the messages because they are all open. So UX, like the user experience on mobile, on web, can be tailored to all the users, whatever they want. They can be like Tinder-like UXs, you swipe, and like graphical UXs, you swipe left, right. You see a message, you like it, you swipe left. You don't like it, you swipe right, whatever. You can have a Tinder-like UX. You could have a feed-like UX, Instagram, Facebook-like. You could have a Reddit-like UX. The UXs are infinite, right? Anybody can build a UX because the data is open. And on the back end, like this is the same diagram that we had before, like content messages here, burn transactions and tags here. And then there are many UX services, each having their own server. They just scrape all of the data here, and then when you connect to a server, they can display you the messages. Like it's simple. Now there's a particular reason I'm kind of insisting on centralized UX here. The beauty of a centralized UX is this, that when you have, let's say, fashion coin, then the makeup companies want their message to appear higher, but they also want to know, because they burned something and their message appear higher, how many people actually came to their website. They want traffic data, right? So when you have centralized UX, they can get traffic data. So let's say makeup coin, the major UXs are UX1, UX2, UX3, and they burned some money and their messages appeared higher on these UXs. These UX companies can tell them how many clicks they got because they burned some money. this is important, right? If you think of it, when you're buying a coffee, you're giving money and getting a coffee, right? For this trade to work, for trade between humans to work, both sides have to be quantifiable. Like they have to know exactly how much money you're giving it, you're going to give them, and you have to know somehow, like at least roughly, what the quality of the coffee that you're going to get. You have to know what you're going to get in exchange for this money, right? But this is kind of possible in our design, because once you are an advertiser, you burn money, your message appears higher, but all of the users looking at this message are looking at through centralized UX points, and by polling all of these centralized UXs, you can know how much traffic you got because your message appeared higher, right? So it makes this measurable. And we'll return to this a bit later, but I want to return to his question because that's really important. So, in the previous section, what did we say? We said that once somebody owns this coin, right? We were somewhere here. In the previous attention backed asset, which was physical, we said like let's think of a token holder, what they would like to do in order to increase the value of these tokens, and we came up with two answers. We said we bring more attention and we get content promoters to burn more tokens, right? And the more both of this happen, the more the value of the coin rises, right? So every coin holder's incentive is to enable both these things. And what I'd say is, now for cricket coin with the digital attention, it's similar because it's the same design. It's the same design, right? So you can naturally think, I can show it through equations, but like if you think about it logically, like analogously, it should be similar. So I can show it through equations, that's fine. But what you can think like commonsensically is the value of your token, when does it rise? It rises when more people come to this common digital location. So if you own football coin, when more football enthusiasts come regularly to the forum, the value of your token will rise. How do you bring more people to the forum if you are a football coin owner, right? So I came up with these methods, right? If I'm a football coin owner, the way I can bring more people is to spread word, right? Hey, like tell everyone, hey, this cool football forum, like check it out, download this UX, check out our forum, right? Spread word, tell them about the token. Then create great content, right? Like if you are a football enthusiast owning these tokens and you create a really good, nice blog, you put that blog on the forum. Because that blog is nice, other football enthusiasts want to come to your forum. So the better content you have on your digital forum, on your digital stream, the more football enthusiasts are going to come back, more the attention. So create great content and create a great feed. The third thing is you also have the power to upvote. Once you're a football coin holder, you have the power to upvote other messages. But if you upvote correctly, you upvote only interesting stuff and you downvote stuff that is not interesting to football coin holders. Think like a football coin owner. Create a great feed. If you create a great feed, more people are going to come and see your feed. Even if they don't want to profit from it, they will come and see it because it's interesting. So that's how we bring more attention. And then on the other side, you want content promoters to burn tokens, right? Only when other people are willing to burn these tokens do your tokens have value. And the more they burn, and the more you don't burn, the more your thing goes valuable. So you want to entice other people to burn. How do you entice other people to burn? So imagine Adidas. Adidas comes to your football coin forum. They burn a lot of tokens. Let's say you have a total 1 billion tokens and they burn like 10 million tokens. And they produce a message. Then your incentive is, hey, they have burned 10 million tokens. I can see that because my UX informs me that. But I want them to return and burn 10 million more. So you upvote their content. upvote their content because you want them to return. They are a customer to your network. Engage with them. Adidas burns a token. You comment on them. You create memes around Adidas. You write reviews around them on your forum, right? You give Adidas, if you think of it now, if you think of it a bit differently, if you're a token holder, what you are really is like a matching mechanism. There is like football related attention, people wanting to consume content, and advertisers. And the better both of these parties feel about the network, the more the value of your token. So you engage with them and you create memes around them. So for Adidas, what really happens in this model is that they get a distributed marketing force. They burn tokens, and all of these token holders are now kind of incentivized to make their content richer, because then Adidas is incentivized to burn even more. And so game theoretically, this has like very nice properties, both for the advertisers and both for people who are not necessarily looking to make money, who are just looking to consume good content. I think the emergent properties of a design like that are very, very fascinating. Now, I think it's already been quite a lot, but this is just a side note. You can write similar equations here. That doesn't matter. But this is the essential game theoretical dimension to this, to the design like that. Now, one of the questions I get, like many times I explain this idea, and I have a lot of difficulty explaining this idea to people because it's new. But one of the questions I get is, aren't you really describing a DAO? Isn't this a DAO? And I say, no, this is not a DAO. There's a certain reason why this isn't a DAO. So let's get into what's the difference between DAOs, like the DAO, and a Jane. So there's similarities between the two designs, right? What are the similarities? Both are implemented using smart contracts. Fine. Ethereum, IPFS, both of them. Both can have no central token issuer. So in the DAO, the smart contract created the tokens. You can do the same thing for a joint at Jane, right? So I create a smart contract. That smart contract distributes these tokens by itself to all of these holders. And then Vitalik has this notion that many people asked Vitalik, what's the advantage of a DAO over a traditional company? And Vitalik said, it's automation. There's some form of automation that a DAO allows that a traditional company just doesn't. Because once you write the rules of a company as a computer program, you can automate many things. And because like Jane is based on the similar platform, Ethereum, it actually has that same kind of behavior. So we won't get into this, but like it meets kind of Vitalik's definition of automation at the center and automation at the edges. But then there are radical differences. DAOs, they pool capital. DAOs, they're like the joint stock company. I have money, so what the DAO try to do is like, you have money, all of us have money, let's pool it together and create a fund. You're pooling capital. A Jane is not pooling capital. There's no capital here. There's only attention. What you're wanting from your holders and other enthusiasts is just attention at a digital forum. It's different. Beauty of this is pooling capital is something we have known for like 400 years. It's an extremely regulated thing, which is why we get into conflicts on securities law. Pooling attention using crypto tokens, I don't think there is a precedence for it. So it's going to be interesting how a Jane is going to interact with the legal system. And it just might be a smoother interaction because it's just something so different. Now, I don't know how many of you really followed the DAO? The DAO. Okay, a lot of you. So I'm going to go into this point, otherwise I wouldn't. So in the DAO, there was this thing which is called a splitting mechanism. Like you had the DAO and you could split off from the DAO. And this really happened because in the DAO there was this problem which is called a majority robs minority attack. So the problem was like this. Imagine this is the smart contract, the DAO smart contract. I sent money, she sent money, you sent money, all of us sent money here. There's this pool of money sitting in this robot. And in the DAO, in the first designs of the DAO, which was way before the system was launched, there was this problem that a majority of us, more than 51%, could vote in a way that we looted the minority of their money. This was called a majority robs minority problem. This is sort of the problem of democracy as well, right? Like if you have a minority group in your country, let's say like, thing that I know of is in a lot of Asian countries, there's like religious conflict. There's a minority religion and majority religion. If you install a democracy, there's a majority robs minority attack, right? The majority can pass laws that screw the minority and loot them in some fashion. And the DAO had this problem, right? It's a fundamental problem of democracy. Jains don't have this problem because if you're in the minority of a Jain, you can sell the token, not go to that digital forum. Nobody can loot your attention. The attention is an unlootable thing. So when you're pooling attention, you're pooling something that fundamentally cannot be looted from you. So because of this nature of attention, there is no majority robs minority attack. And this makes it super easy for implementation on Ethereum. And once you don't have this attack, you solve half the design complexity of the DAOs. Yeah.
But don't you have replication in those networks? If you pick out a minority, I mean, the minority loses its reputation.
The majority loses its reputation, yes. So I'm not saying that this problem of the DAO is unsolvable. I'm saying it's a problem and it needs to be mitigated through systems like reputation. That makes the designs more complex. It's not unsolvable, it adds complexity. Beauty of this design is it doesn't have this problem, which means the design can be lean. At its core, it can be the leanest thing. So now I'm going to go through these two themes, and then then we'll go through a round of questions and maybe return to some of the things later. But this is how I want you to. So if you have not followed anything in this particular talk, and I could completely sympathize with that, because it took me months to wrap my head around this. Right? For me, maybe now it's become easy, and completely sympathize if it's not for you. This is what I would like to take home. We've had the information web. Tim Berners-Lee's magical idea of linking together documents through these links, digital data linking to other digital data, to other data, to other data, making a giant information web. We've had this thing for 25 years, and we have built it continuously year after year after year. What Tim Berners-Lee, many venture capitalists and programmers in the previous web revolution didn't appreciate that high, and we could think why, is as important as this web was the tools by which you could browse, by which it's decided what part of this web you look at, right? So think of it. There's the microscopic world, right? Or there's the universe, the telescopic world. But these are giant things, giant informational objects. The microscopic world is giant, the universe is giant in a way we can't conceive. So when you have such a giant informational object, what you really need is like this telescope or this microscope to tell you where to look at, right? Where should I look? And the web has also these lenses. So Google is a lens. Right? Basketball shoes, or I don't know, Bitcoin. I think of Bitcoin. Where do I go? I go to Google. Google is a lens, right? There's this giant information web, but then I want to look at parts of it, and who tells me what to look at? Google tells me what to look at. Right? Because I go and I search. Google gives me the result. That's a lens. That's like a telescope or a microscope. Facebook is like a telescope or a microscope. I want to look at something, but I want to look at what my friends think is cool. That's a lens. Like Facebook gives you that lens. Look at what your friends think is cool. So the real money in the previous revolution was made two ways. Building lenses to view the information web, and very recently through the sharing economy. This is the two major ways by which all of these companies succeeded. anything else really failed. I think the golden opportunity in front of us is this. We can build the lenses to view the information web, but we can build them through open source, remunerative protocols. I would still not say fairly is not guaranteed yet. If we don't build it well, fairly is not guaranteed. So I should remove that. But we can build lenses, these microscopes, to view this giant information structure, but we can build them open source on Ethereum through these tokens. It's a lens, right? If you're a football coin, and this football coin, I go and see this digital forum that all these football coin enthusiasts have created. They have essentially created a lens for me, right? Here's what you should look at. But then the design of this lens is open source, and it remunerates these people who are creating this lens. Go ahead.
So I was asking you before already, but this is based on the plutocratic model of more money, more attention.
Yes.
Which automatically creates a bias, and it might happen as we have it in the web too, that once you have, for example, more followers, it's really hard for newcomers to catch up. You thought of, I mean, this is very new and exciting already, so you're trying to wrap your head around that, but have you already started to have thoughts on?
Yes. So there's so what Dr. Shermin's question is actually a very important one, and it's a question I don't have an answer to. That question is this: okay, you can build these lenses, these open source lenses using these tokens, and let's say this kind of design is right. Her question is sort of like 20 years from now, when all of these lenses are built for all of the niches, how do you ensure that there's some kind of equitable distribution of these tokens? I personally think this is a hard problem. It's a hard problem even in Bitcoin, right? If you look at the model of Bitcoin, it's fairly plutocratic. Ethereum also is fairly plutocratic.
So would it be maybe a solution to go away from one? We currently buy tokens with money, but if we go away from one token and go to one ID, once we have resolved the ID issue, we can enter a new game.
Into a new game. So the idea is this, that today the reason it's very hard to distribute any kind of wealth over the internet fairly is that you don't know, you have the Sybil attack problem. So what's the Sybil attack problem? Let's think of a company that really tried to distribute money fairly over the internet. That's the Stellar Foundation. So the Stellar Foundation created this currency that's called lumens. Their idea was, we want to distribute lumens fairly to all the people. So if you have a Facebook account that has a lot of friends, just give us the info to your Facebook account. We'll treat you as a unique individual, and we're going to distribute you some tokens. And they wanted to do this because they wanted to send these lumens to as many people around the world as possible. They wanted a fair distribution of wealth, this crypto wealth. And the problem turned out to be that people gamed that system. That you had ways by which you could do Sybil attacks against the lumen distribution, and you could accumulate way more lumens than you were really entitled to. So the idea was like one person gets only 5,000 lumens, but then there were ways, I won't get into them, by which were like one person could get 1,000,000 lumens. This is a fundamental problem on the internet because hard to know if you get a public key, whether if you get like 10 public keys, whether they are owned by the same person or by different people. If we had a global identity system of some form, whether Uport, like all of these things, Consensus, the cool company Consensus is trying to build, if you had a global identity system like OneName is trying to build, then this would be easy. But we don't have a global identity system. So I don't know how to solve the fairness problem, right? Now, I must mention here that Simon de la Rouvière, he has a lot of cool notions on how you can deal with the fairness problem. And maybe you might invite him from South Africa in one of your next meetups.
Isn't publicly unique to one individual?
No, you can generate infinite public keys. So the public keys, the way they work is you can have a script that generates 1,000,000 public keys every second.
But I mean, why publicly is unique to me?
No, you can have infinite public keys.
Okay.
So, I mean, if you want to do the experiment, go to bitaddress.org and just keep on clicking. They will keep on generating public keys for you. This is the essential problem. Like, so maybe this will be solved, maybe it won't. I mean, I know this is a problem with this kind of approach. I don't have a really nice solution today.
So what you suggested, we can be the alternative to Facebook?
Yes. It's not an alternative to Facebook. I don't want you to think of an alternative to Facebook. I want, the way I would like you to think of it is, we can build a way to filter the information web. Now, Facebook also filters the information web, but this will be different from it. It may not compete against it. It might not disrupt it. It might not replace it. Maybe in the future we have Facebook for your friends and these kinds of lenses for other things. Like, Google did not die because Facebook existed, right? Google did not die, Google search did not die because Facebook was born. If this is born, that does not mean Google and Facebook will die. The three could coexist, right? Because they serve different functions.
But why should I go to Facebook? Facebook is selling my information, selling to corporates. I can migrate all of my information to an open source platform and make money off of it as well.
Yeah, so, I mean, if the world was full of people who thought like you, I would say,
There is money incentive, so that's, everybody can follow that.
yeah, maybe that will end up happening. So what I'm trying to say is, I don't know, as just a person writing this paper, I don't know how the future is going to play out. Maybe the future is this kind of design disrupts Facebook. Maybe the future is it doesn't. Maybe it's just two different systems at last. Maybe some other design outcompetes Facebook. I didn't do this with the I'm not writing, building, or explaining this with the intention of disrupting Facebook. I'm just doing it because I think we need a joint attention network. Yeah.
And you've mentioned that advertisers might have an interest to burn these tokens, right? So somebody needs to buy them up from the marketplace and want to burn them. Have you given thought of other broad categories of entities that might have an incentive to burn and generate or try to have people consume their attention other than advertisers?
So my internal feeling is, I say advertisers because advertisers is what we understand, right? We have an intuitive feel for what an advertiser wants. My feeling is in a design like this, what we will realize is the people that are really burning are the people themselves. Like you know, right? Like, I don't know what you, but I have the feeling that many times I want some of my message to go up high to the Ethereum community. I really do sometimes. Like during this DAO situation, many of us had this feeling, right? We wanted our message to be high. And I think it's not just advertisers that want their message to go high. It's like normal people, it's like entities of all forms that want their message to go high. I'm talking advertiser because that's what we understand. But I think the future advertiser is us. It's not really a giant company. That's my feeling, but I don't have something to prove that. So, right? Yeah.
You said the amount of tokens is fixed at the beginning, and so you have a certain number of users at the beginning that share their tokens, and how does it work when other users are coming into the community, and how do they distribute the tokens?
Yes. Okay, so now the reason yes, you are right. I have said that the number of tokens is fixed, and I have said that not out of solely out of an attempt to make this simple, right? Like you can have way more complex models, way more, and the more I go into that complexity, the more my core message would be lost, I think. So I think there can be many models for how these tokens work. So one of the models could be This one. There are other models, and Simon is the right person for this talk. Yeah. Go ahead.
Yes, I have a question as well. So this model, what you've described, seems to primarily revolve around communities with user-generated content. Like it sort of applies very easily there. But what if, like, we with Epicenter wanted to do something like that, where you have a core set of or a company producing content? How would that change?
Yes. So I think in Epicenter the numbers wouldn't add up, but let's not think Epicenter. Let's think Game of Thrones, HBO. So Game of Thrones has a lot of enthusiasts like me. I really consume Game of Thrones content. Like I go to YouTube every day and my feed is full of Game of Thrones video analysis of past episodes, what's going to happen in the future, like speculation. Like I do all of that. Now, the interesting thing is maybe the future is like this. Like you create a TV show and you create a token with it, right? And then you get a big list of people from Netflix. You get a list of people that are watching your show, and you distribute this token to all of them. And then you hold some of these tokens. Like the company that does this owns 5% or 10% of these tokens, and they replicate this experiment, right? And these tokens gain in value, and that is how they monetize the TV series.
So how does the token gain value in the same way?
Because the token represents the access to the attention of this community. The same way, like we did cricket coin, football coin, there's like the Game of Thrones community. If all of them had this token and they were going to the same digital location every day, then somebody wants to send messages to this community. So somebody is burning these tokens, and burning these tokens gives these tokens value.
It's like entrance tickets, right?
It's like entrance tickets to the attention, yes.
So if a concert is sold out, you can go and try and sell them on the black market before the concert starts. Which
So I actually didn't get that, but
well, there is a limited amount of tickets
yeah,
you can sell for a concert in a certain physical location. You can't sell more.
yeah.
Once it's sold out, the price goes
Up.
based on supply and demand.
Exactly. So if you imagine, like let's say I'm like this super talented director, and I create this TV series, and when the TV series is young, maybe only 5 episodes, I distribute these coins to all the enthusiasts. I keep on creating content, and I hold 10% of this supply, and I keep on creating this content. Because I'm creating great content, these nice TV series, the number of enthusiasts goes up from like 50,000 to 5 million. The value of these tokens shoot up. Other people look at, oh my God, that's like going up so high. Other people are interested in it. They start following the TV series. They start buying these tokens. That is how a TV series becomes viral. And the way you make money is like you own 5% of the supply. That goes up in value. That's how the director makes money. That's how New York Times could work in the future. That's how media could work in the future, right? Like this is like a model for media as well. Epicenter Bitcoin, maybe we are just too small for this game. I don't know.
So it doesn't seem to me though that this whole model translates to something like Bitcoin, where the point of it is to be money and the means of payment.
Payment, yeah, money.
Do you see that the same way, or do you think this whole model applies
Yes.
to that, something like Bitcoin as well?
So I'm going to come to this on a slide. So I'm going to come to this on a slide, and I don't have very strong convictions on it, but I'm going to talk about a hypothesis. So that's Dow versus Jaynes. So that's the take-home message. Lenses to view the web, open source, remunerative lenses. Now, this is the radical part of my talk, landing on planet radical. So I have made you cosmonauts or astronauts in this attention universe, right? You have been inducted, and you are now going to journey through this attention universe. And in this universe, you're going to find this planet, which is like full of radical ideas about the attention economy. And I'm going to show you like what this planet looks like. And these are all speculative, radical ideas. I think they are true. I think they are right, but I can't prove them. And I put this section just so that it's interesting. First radical idea is this. In the Ethereum community, we had the notion of a DAO. A DAO pools capital. A DAO is decentralized. A DAO is autonomous. A DAO enables automation. A DAO is a beautiful idea. We have Jane. And they are going to mate. And they are going to produce children that we can't anticipate. That's a radical idea I want to think about. Like, what are these children going to look like if the design of Jane is correct? The second radical idea. Now, I think the strange thing is, if this design is right, I think the economists are going to have new tools at their disposal to understand how economies work. So in economics, if you look to economics, there's like a lot of models on how firms work and how economies work. If you want an example, there's Solow's model, which describes how economies grow, right, as a function of certain inputs in the economy. And if you look at the whole economics deals in scarcities. Right? What are the scarcities and how they are going to be used in order to produce something of value? And the way you combine a scarcity and to produce something of value reflects like productivity. Right? Productivity is high, which means you can utilize these scarcities really well. The meaning of productivity being high is like you have some scarcities, land, labor, and you can combine them efficiently to produce unique things. That is what it means when you say that productivity is high. So economists think in terms of like scarcities. And in economics, in the traditional microeconomic models, there are usually like 2 or 3 main kinds of scarcities. One is land. We all understand land as a scarcity, right? There's labor. Labor is a scarcity. Total number of hours we can dig, we can operate machines, that is scarce. Economics capital, whether of the money kind or physical capital, is always scarce. So if you look at the Solow model, they combine these two in order to have equations about how economies work. And I think the future, like if this is right, and I'm still not sure, then we need to add a scarcity. We need to add the scarcity of attention. Because these networks, Janes, are going to make sense only when you think of attention as a scarcity. And this is Goldhaber's radical idea. This is not my radical idea. This is Goldhaber's radical idea that attention is the essential scarcity. All I'm doing is I'm saying, in order for us to fit all of these things in traditional economics, we're going to need to add a 4th scarcity. Now, every different school of economics has its own list of scarcities, and these are only the most common. I think these are called the classical economics. In classical economics, you have these scarcities. But I think there will be, if this idea is right, a new kind of economic model that actually starts to model attention as a scarcity and have networks around it, etc. And the third big thing. So this is what I call the strong Jane hypothesis. The strong Jane hypothesis is this, that the future is full of Janes. The future is full of attention-backed assets. And 20 years from now, there are going to be so many of them that we are going to think of Bitcoin and Ether as attention-backed assets. And we are going to think of Bitcoin and Ether as Janes. And you're going to think of Satoshi Nakamoto as the inventor of the Jane. Because in a sense, this is what they do. This is what Bitcoin really does. It pools sort of all of our attention, all of our energy around this Schelling point, which is represented as a token. And the strong Jane hypothesis says that in the future, once this idea is successful, we are going to start thinking of Bitcoin and Ether themselves as Janes. And this equation that you wrote for Janes is going to be valid for them as well. Today, it doesn't make sense. It doesn't make sense because nobody is burning Bitcoin and Ether in order to get the attention of the Bitcoin and Ether community. Nobody is doing that really. So today, the strong chain hypothesis seems like a crazy, stupid idea. But if this idea succeeds on scale, then I think maybe in the future, we're going to think of these as attention-backed assets as well. But only the future will show whether this is true or not. So now I want to acknowledge some people. I want to acknowledge some people because they have really influenced my thinking. The first is Maciej Olpensky. So I got to know Maciej when I was like a show host for Epicenter Bitcoin. I interviewed him, and we kept on talking. And Maciej went to this Boom festival this year, and he came back with this notion of burning things to gain attention. Like he was like, man, I should be able to burn Ether to get the attention of the Ether community. And I was like, no, why should you be able to burn things? Like this doesn't seem like a good idea at all. And he kept talking about burning things, and he kept talking about attention as a scarcity. And eventually I kind of connected that his burning implies a financial model, his burning implies a general design, and his burning implies kind of the Jane. So it was like his seed, it was really Maciej's seed of this burning. He was like, burn to get Ether community's attention, burn to get Ether community's attention. He was like very fixated on this idea. And this grew out of that fixation, like, okay, what if I started to write mathematics, I build mathematics around this? What would happen then? So I really I'm indebted to Maciej for like starting me on this journey. Michael H. Goldhaber. If you like this, you got to read this guy, because he wrote about the attention economy in 1996. He wrote about it, he gave talks about it, people ignored him. He gravitated to become like a normal journalist. Like he completely changed field. But like his writings, if you really go through it, like given I think the perspective from which I am approaching it, like he is the real legend. He is the real legend. And then Simon, so I would encourage you to invite both Maciej and Simon here as well. So Simon had like a very related idea. He had the idea of a personal attention bond, in which Brian would create this asset that represents his attention, and people can buy that thing or some related commodities generated by that thing, and then using those things, they could upvote messages that Brian would see and he would do. So he had this notion of this personal attention bond. I think personal attention bonds could work for celebrities. They might work for celebrities, but they will not work for most of us. I think personal attention bonds can also fit in the financial model. The other thing that Simon independently thinks about is the problem of token distribution. So you asked the question of how do you distribute these tokens, right? So one of the models could be that football coin or Game of Thrones coin has this central committee or central organizer, and then every year some new coins are created and they go to the central organizer, and then that helps the central organizer fund the network or improve the network. So Simon has other ideas on doing this, and I think they constitute a talk on its own. So I would really like to acknowledge these guys because they have kind of facilitated my thinking. I would also like to acknowledge my wife Kiran, because working on this thing, like she really bears with me, and like she listens to all of my ideas, even though they don't make sense. So I'm really indebted to her as well. So these are the resources. Check them out. Simon and Maciej and Michael Goldhaber. Even though my whole talk might be false, I think the combination of all of this has some truth about the future of the crypto space. Okay, now let's get into questions and then break for the day. Yeah.
I think you will be able to apply this for web, no? With Ethereum, for instance, you can write smart contracts, etc. You could be I think at this point we'll be able to implement
Yes.
the ideas that you presented. Are you planning to do this soon? Or the
Yes.
first step is this paper you're writing, right?
Yes. So right now what I'm really looking for is business cards of people that are willing to review my paper. And I'm really looking for reviewers. There's the question of implementation, and sometimes I think I want to focus on the theory of it, right, and interest other people in the implementation of it. Sometimes I think, okay, maybe I'm going to implement something, but I really haven't decided on it. What I am pretty sure is I'm going to put pen to paper, come out with a paper, a white paper, and release it. I don't necessarily want to create my own chain or my token or do a crowd sale. These are not things that interest me right now. They might interest me in the future. So I'm kind of leaving that question open. But I think talented engineers could really implement this. It's not such a complicated thing to implement. Another question, yeah, Ben.
You hinted at this during your responses, but have you considered some form of liquidity problem, especially in the beginning?
What is a liquidity probe?
Liquidity like that, you have a very long tail of like hundreds, if not thousands, of very unknown genes that have no reputation. So how do you get to a reasonable scale that there is an actual market for this attention to be bought?
So you're saying the market is fragmented in some way.
And you hinted at this, right? When you, for example, when you said like epicenter Bitcoin would be too small to really play this game. So you're obviously thinking about bigger ways of addressing bigger crowds so that there would be this liquidity. But have you given more thoughts? Are you like?
Yeah, no, I really don't know. I think right now, if this is right, then the opportunity is like make the big things, make football, make cricket, make the big things. Maybe in the future we might have something for small things, like how they can remain competitive. I haven't thought of that dimension. What I have thought of is like the question that came to my mind is. If this idea is out there and everybody is creating football coins, won't that just fracture the market? Like there'll be hundreds of football coins and none of them would be individually valuable because all of this attention is fractured. And I think like if you think of Bitcoin, what Bitcoin is doing is it's pooling the attention of all the gold bugs and libertarians of the world. So there's this meme which is gold bugism or libertarianism, and it resides on many minds of this world. Somehow Bitcoin is pooling all of it together. And the strange thing is Bitcoin has a very strong competitive edge against any other network. For some reason there's this one dominant network and then everyone else is small. And Ethereum is pulling the attention of all the smart contract enthusiasts around the world, right? Like if you're a smart contract enthusiast, it's like you pay attention to Ethereum. So strangely enough, like these networks, they kind of gravitate to there's being like very one giant network and the rest are like small.
That's not strange. I mean, that's the first mover advantage.
That's the first mover advantage. So thinking of this, I think that even for football coin or cricket coin, it will be similar. There'll be like one massive football coin, and then there'll be like a long tail of other coins trying to be like that one. And like, so this is like kind of naturally going to prevent the fracture of markets. There's going to be like common selling points that have a lot of value. Yeah.
No, I just wanted to say that, I mean, there is a project, LTV coin, which essentially built almost exactly this.
Exactly this.
And I guess what's also interesting is that it didn't really work. And I think liquidity was one of the problems. Even though it had pretty good distribution, actually, I think it probably had, maybe 10,000 coin holders or something. And the other huge problem is UX.
Yeah.
These are the tools, which is
going
to take a long time until those are
Yeah.
built.
So if you look at the history of the crypto space, and very early on, my thing used to be I used to go to CoinMarketCap and scroll down from 1 to 100. I wanted to see all the coins, what they are. And the thing is, like in the early history, there was a lot of these coins. There was one called pot coin, that was for marijuana. Like there was LTB coin. There were quite a few like these that were trying to pool members of a community together. So there were a couple of different experiments. There were experiments that were trying to pool members of a country together, or a coin, people of Iceland or something like that. And then there were these coins as well, and none of them succeeded. And Brian's question is, why didn't they succeed, and why do you think the future has this kind of? So I actually think, I'm not sure anybody has ever developed a theoretical foundation for this, and like how to make these tokens valuable. And we haven't really thought of this idea on a large scale, right? Like, magical things happen when a lot of people think on an idea. And we haven't thought on this idea on a large scale. So maybe once we start to do it on a large scale, which is why I want like write the paper, get reviewers, like evangelize this idea, is like we start to think of this on a large scale, maybe we can make it work. Yeah.
Have you thought of the idea of like split chains or like sub-chains? I mean, you have this one board, and then you might want to diversify the football enthusiasts into, I don't know, female football, male football, LGBT football, whatever. Is there room in your formula to do that?
I haven't thought on this line at all. No, I mean, yeah, I hope we will think on it. I haven't really thought on it. I mean, for me, it's been a struggle just to get it to this point. Yeah, it's really truly been a struggle to get it here. And maybe we could do things like that. We need to think on it.
Let's do 2 more questions.
And then we'll break for the night.
Anyone?
Yeah.
What happens to free riders, people that benefit from user-generated content or the community and don't get shown an advert, don't get exposed to this network or
Yeah, so actually my feeling is, and this is a feeling again, my feeling is the real consumers of these tokens are not going to be really advertisers, but us, normal people burning things in order to promote their ideas, like during the DAO hack and stuff like that. So it would be really hard to filter that out, because if you filter that out, that is the actual content. So I actually think it will be very hard to filter it like that. But what you are pointing out is actually one of the problems that genuinely worries me about this design, and I'll try to frame that problem. So there's this problem which is called the tragedy of the commons problem. So tragedy of the commons problem works like this. In any like financial game, if there is a method by which you can get the benefits of the system without paying the costs of the system, then people gravitate towards not paying the costs of the system. And when everybody does that, the system breaks down. So a tragedy of the commons kind of might be that we take all of this beautiful German infrastructure for granted, U-Bahn, S-Bahn, H-Bahn, the tram, like so awesome. Take all of it for granted, but all of us need to pay taxes in order for this to work. And if it was very easy to evade taxes, then all of us would evade taxes. And this infrastructure would fall down, right? So if there's a method by which I can take the advantage, but not pay the cost for it, and if all of us do it on scale, the infrastructure falls down. Now, if you look at it in this design, the issue is that there's nothing that is compelling any of these people to either upvote content or look at content or look at this message board. It's all voluntary, right? So what if you had a way by which you could just buy these tokens, benefit from their value going up, and not do anything to upvote content or create new content, or you don't even pay attention to the board, but you hold the token, you want it to go up. And what if all of the holders of this token did essentially that? Wouldn't this like fall apart? And this is like one of the things that worried me. But what I think is, like humans are optimizers, but humans are like not perfect optimizers. So look at it like this: like if you are a football enthusiast, you really want to consume football content. Like if I'm a Game of Thrones enthusiast, I want to consume Game of Thrones content. For me, there might be some people that might say, let's own the Game of Thrones coin, but not contribute anything here. But then, like the person who's going to buy Game of Thrones coin, who's going to discover it, is going to be that guy who's interested in Game of Thrones, and he wants to consume content. Like humans have a need to wake up in the morning and like see something. Humans have a need to wake up like, I'm getting bored, I want to see something, and you will see something related to your interest. So if your interest also has a coin, I think even though there is a potential tragedy of the commons problem here, I think the large scale networks won't really see this problem, because we have an internal desire to discover news about the world and our interests, and we are leveraging that. Now another thing here is the numbers. Like I didn't go to the equations, but I want to get you to get a sense of the numbers. So if you can move 1 million clicks, like if there's a joint attention network, is a chain that can move 1 million clicks, like somebody burns a lot of tokens and they're going to get 1 million clicks out of it every week. If you can move 1 million clicks every week as a chain, and each click is priced at $1, then the total value of that chain is going to be like $1.8 billion if you assume 3% interest. So there can be massive chains, like 1 million clicks a week is not that high a number. So you can have really massive chains as well. I think you'll have chains that are bigger than Bitcoin. That's my crazy prediction. But there is a tragedy of the commons problem, potential tragedy of the commons problem here, but I don't think it will work out that way. I think we really want to consume content, we want to be social, and this design is kind of leveraging on that. Another question?
All right,
Last one.
So as this whole thing continues and advertisers continue to burn all their tokens, at some point they will get so scarce where eventually there won't be any more left. So in your model, you're actually planning that there are more tokens will be generated, or how does that work?
We can have models where new tokens are generated, like Bitcoin, like Ether, new tokens are generated. We can have them. We can distribute these new tokens through mining. We can distribute them to the organizers. We can have other models as well. But to your question, what I'd like you to appreciate is there are two things to it. With crypto, the beauty is you can create infinitely divisible tokens. So today, an Ether is divisible in a 10 raised to 18 way. And if someday we start burning Ether, then the Ethereum system can be reconfigured to have not 10 raised to 18 way, but like the minimal unit goes to like 10 raised to 30. So these things are truly infinitely divisible. So even if people start burning a lot, you can divide the rest into finer and finer things and still make the market go, right? That's one property of a crypto token. The other property is, once you have a market cap, let's say a chain has a market cap of like $1 billion, and somebody burns 1% of the coins, then the way it would work is the price of the token would go up, and the amount by which it would go up is roughly such that the market cap of 1 billion will be preserved. This falls out of the equations. I haven't gone into them to avoid this kind of discussion, but this is like a very dynamic system in which if you burn, the value of the token rises and the market cap stays constant. So even if people burn a lot, the rest become more and more valuable, and they fill this need of the asset, the financial side of the asset. I think let's break. It's been a long evening. Thank you so much.